What if I told you that 4 of the world's top traders, men who have turned small accounts into multi-million-dollar fortunes, quietly revealed the mindset, routines, and trading systems that help them do the impossible? And what if all of it was captured in one conversation? Welcome to Momentum Masters, a rare roundtable where Mark Minervini, David Ryan, Dan Zanger, and Mark Ritchie to break down exactly how they think, how they trade, and how they survive when the market turns against them. This isn't theory. This is the playbook of traders who've actually done it. Before we dive into the lessons, let me ask you something. Have you ever felt like you were almost getting the market right, catching a breakout, spotting a trend only to watch the stock reverse the moment you hit buy? Or maybe you've had that one big winner completely erased by one oversized loss? If that sounds familiar, you're not alone. And that's exactly why this book hits so hard. Because these 4 traders didn't start out as legends. They started out exactly where most people do: confused, emotional, inconsistent, and losing money. What made them different wasn't luck, connections, or some magical indicator. It was discipline, process, and a commitment to mastering momentum, the ability to identify the strongest stocks at the right moment with the right risk. And right from page 1, they make something crystal clear. Success in the market doesn't come from predicting the future. It comes from reacting faster and smarter than everyone else. In this video, you're going to learn the core principles that turn these traders into super performers, the psychological rewiring that separates winners from gamblers, the exact conditions they look for before entering a trade, how they size positions so one bad trade never destroys the account, why the strongest stocks often look too expensive to beginners, and the mindset that keeps them confident in chaos and humble in bull markets. But here's the twist. Even though all 4 traders are momentum specialists, their approaches are surprisingly different. Minervini is the master of precision timing. Ryan blends slim fundamentals with chart perfection. Zanger rides monster moves with an artist's eye. Ritchie is calm, systematic, and brutally honest about risk. Together, they reveal something most traders never learn. There isn't one right way to trade momentum, but there are a few wrong ones that will absolutely wipe you out. And that's the real power of Momentum Masters, the contrast. You get to see 4 traders, each with their own style, agree on the rules that actually matter. Rules like cut losses fast, never average down, focus on stocks making new highs, let price confirm your thesis. Your biggest enemy isn't the market, it's you. So buckle up. Because if you've ever wanted to understand how elite traders think, how they build conviction, and how they survive market storms that kill most portfolios, then this book and this summary might be the mindset shift you've been waiting for. Let's get into it. Chapter 1 opens with a compelling premise. Many traders reach out to Mark Minervini with one question: how do you actually become a successful stock trader? And not just occasionally, it's dozens, then hundreds of such questions from novices and veterans alike. Minervini explains how his past book, Trade Like a Stock Market Wizard, provided a deep dive into his methods, but left a hunger unanswered. Traders still had questions. That leads into the core logic of this book. Instead of a traditional narrative or biography, the authors chose 130 real questions submitted by actual traders, questions glaring in relevance, grounded in real-world situations. VDOC.pub. Then they brought together 4 top-tier traders: Mark Minervini, David Ryan, Dan Zanger, and Mark Ritchie II, and set up a roundtable format. Each question is answered by each master, side by side, enabling the reader to compare and contrast their approaches. The introduction stresses to big things. 1. No fluff, all substance. The authors declare, this book is pure trading, no lengthy life story detours, no filler. It's about what works in the market, drawn from actual elite traders working in the trenches. 2. Look for common principles across diverse styles. Although each trader has his own style, Ryan and Minervini leaning small, mid-cap growth stocks, Zanger leaning large, mega-caps, Ritchie bringing systematic fresh eyes. What unites them are the core practices: discipline, risk control, momentum focus. The reader is urged to pay attention not just to the differences, but to the consistencies. Another key message: to succeed as a trader, you must know 3 things: what to buy, when to buy, and when to sell. Even more important, you must align your trading style with your psychology and strengths, and fix your weaknesses. This isn't about replicating someone else's trades. It's about building your own version of the system using proven principles. Sacred Traders. The chapter also provides a bit of the landscape, how the trading world is filled with conflicting advice, endless systems, and distractions. The Four Masters shared message: strip it back, understand what really governs super performance, apply the rules, stay consistent. Finally, Chapter 1 sets expectations. It tells the reader, you won't get wasted pages of anecdotes. You'll get questions that matter and answers that work. If you're serious about becoming a trader who performs, not just survives, you'll want to study the structure of this book, absorb the contrasts, and apply what the masters agree on. So if you're ready, buckle up. This is not a lecture, it's a conversation with champions. Chapter 1 gets you oriented. Here's why the book exists, how it's structured, and what to expect. And most importantly, it challenges you to look inward. Do you have the discipline, the mindset, and the structure to trade like a master? Chapter 2 functions as the onboarding section of the book. Before the trading principles begin, the authors introduce the four traders who will be answering every question. Throughout the roundtable, the purpose isn't biography for entertainment, it's context. The book wants the reader to understand why these specific traders deserve a seat at the table, and what unique edge each one brings. First is Mark Minervini, arguably the core architect of the project and one of the most respected growth momentum traders of the last several decades. His reputation hinges on two things: extraordinary performance and an equally rigorous risk control philosophy. Minervini's breakthrough came after years of struggling, failing, adjusting, and rebuilding his method. He eventually developed his well-known SEPA-specific entry point analysis framework, which focuses on early identification of emerging leaders, tight risk, and precise timing. His signature: consistency. He has produced returns that most traders consider statistically impossible over sustained periods. Chapter 2 frames Minervini as the technician with discipline, someone who treats trading like a performance craft rather than a prediction game. Next is David Ryan, a three-time U.S. investing champion and a direct product of William O'Neill's slim philosophy. Ryan represents the hybrid trader, someone who blends fundamental strength, earnings, sales, margins, leadership quality with technical confirmation. The chapter emphasizes that Ryan learned directly under O'Neill, giving him hands-on exposure to the original principles behind momentum investing. His value in the roundtable is experience. He has traded through multiple major market cycles. Going back to the 1980s, Ryan acts as the bridge between classical growth methodology and modern momentum execution. The third trader is Dan Zanger, famous for turning a small account into millions in one of the most aggressive, high-momentum bull markets in history. Zanger built his name through chart mastery. His skill lies in recognizing patterns with near-instinctive accuracy, cup with handles, flags, high-tight flags, ascending bases, and entering when momentum is explosive. Unlike Minervini and Ryan, who often deal with emerging or mid-cap leaders, Zanger tends to focus on large-cap names with strong liquidity that can produce massive multi-week or multi-month runs. Chapter 2 describes him as aggressive but highly skilled at controlling exposure. When the environment breaks down, his contribution: velocity, understanding how to ride big moves without losing control on the downside. Finally, Mark Ritchie II brings a different voice: systematic, psychologically grounded, and heavily process-driven. As the son of Mark Ritchie Sr. from Market Wizards, he grew up around trading, but built his own approach centered on risk containment, decision flow, and emotional control. The chapter frames him as the quiet strength of the group, analytical, humble, and brutally realistic about danger. While Minervini, Ryan, and Zanger represent decades-long public performance, Ritchie II represents depth and behavioral mastery and internal discipline. Chapter 2 ends by highlighting the value of contrast for traders, for personalities, for methods, yet one shared belief system around momentum, risk management, and personal responsibility. Their differences make the book dynamic, but their similarities make it instructive. The message is simple: If for top performers agree on certain principles, those principles are worth studying. Section 1 serves as the true launch point of the roundtable. This is where the For Traders begin answering questions, and the book lays down the foundational mindset required to understand every section that follows. The tone becomes more direct, more practical, and much more focused on the psychological realities of momentum trading. The chapter opens by addressing the biggest misconception most new traders bring into the market: the belief that trading success is primarily about finding the right stock or the right indicator. The For Traders immediately challenge this. They emphasize that the real battle is internal. The strongest common message in this chapter is that you cannot outperform the market if you cannot control yourself. Technical knowledge is necessary, but psychological discipline determines your longevity. Minervini points out that the majority of traders lose not because they lack skill, but because they refuse to follow rules consistently. He stresses the idea of self-awareness, knowing your tendencies, your weaknesses, and the areas where you sabotage your own performance. Ryan reinforces this by noting that most traders spend excessive time searching for setups and almost no time refining execution. He explains that great trades are not the result of genius prediction, but of following a structured playbook every single day. Zanger brings a unique flavor to this section by reminding readers that the market rewards speed. Momentum stocks move fast, accelerate fast, and collapse fast. If a trader cannot make decisions without hesitation, they will always be late. His message is straightforward: the market doesn't wait. You need to recognize high probability conditions quickly and act with conviction when the setup is valid. Ritchie II, meanwhile, grounds the conversation in risk. Unlike the others, he speaks heavily about capital preservation from the very start. He emphasizes that many traders underestimate how quickly risk can compound and how often small mistakes turn into catastrophic losses. His framing of the market is almost clinical. If you don't have predefined exits, the market will eventually force one on you, and it will not be gentle. A key theme in this chapter is alignment. All For Traders stress that trading success depends on aligning your style with your personality. They warn readers against copying trades, mimicking someone else's time horizon, or adopting methods that clash with their own psychological makeup. Momentum trading requires decisiveness, emotional resilience, and the ability to absorb frequent small losses without hesitation. If that clashes with someone's natural temperament, they either need to adapt or choose a different trading style. Another important concept introduced here is the idea of process over results. Minervini highlights that traders who obsess over outcomes typically distort their behavior, chasing gains or refusing to cut losses. In contrast, traders who focus on executing their method correctly end up with better long-term returns. Because consistency compounds, the chapter closes by framing what the reader should expect in the rest of the book: a breakdown of how elite traders think, evaluate risk, time entries, manage trades, and stay mentally resilient. Section 1 sets the psychological baseline before discussing stock selection, chart patterns, or entry criteria. The book makes one thing clear: without a disciplined mental framework, no technical knowledge will save you. Section 2 dives into one of the most important questions momentum traders face: how do elite performers choose the right stocks? This chapter reveals the core principles each trader uses to filter thousands of tickers into a small list of high-potential candidates. The answers differ in style, but the underlying logic is consistent. Great trades begin with great stock selection. The first major theme is strength. All For Traders emphasize that they focus on stocks already demonstrating superior price movement relative to the market. Minervini stresses that strong stocks often look expensive to beginners, but strength is a signal, not a danger sign. A stock hitting new highs is showing demand. A stock lagging the market is sending a warning. The masters agree that most losing trades come from trying to pick bottoms or buying weak stocks simply because they look cheap. Ryan expands on this by highlighting the role of fundamental leadership. He looks for companies with standout earnings and sales growth, expanding margins, and clear competitive advantages. His slim background guides his process. The strongest price performers almost always come from companies with superior financial performance. He reminds readers that momentum without fundamentals can work in short bursts, but sustainable multi-month moves typically require real business strength behind the chart. Zanger approaches stock selection through chart behavior and pattern structure. For him, the telltale signs of the next big mover are clean patterns, tight price action, rising volume on up days, and reducing volume on pullbacks. He wants stocks that set up well, meaning they form constructive consolidations that reveal institutional accumulation. Zanger's message is simple. Sloppy charts usually reflect sloppy demand. Clean patterns reflect organized buying. Ritchie II contributes a more risk-focused perspective. He evaluates stocks not only by their upside potential, but also by how quantifiable the downside is. He prefers stocks with logical areas to place stops and avoid setups that have unpredictable volatility spikes or illiquid behavior. For him, a stock is only good if its failure point is clear and manageable. Stock selection is inseparable from risk evaluation. The next major theme is relative strength versus market conditions. All four traders insist that selecting great stocks means nothing if the market environment is weak. Minervini is especially strict about this. He avoids buying growth stocks aggressively unless the general market is confirming strength. A strong stock in a weak market is usually a trap. Successful traders wait for alignment between individual leadership and overall market health. The chapter also highlights the importance of sector leadership. Strong stocks usually emerge from strong groups. If a trader sees one biotech name surging, that's interesting. If an entire biotech group is moving, that's meaningful. Institutions buy themes, not isolated tickers, and momentum traders position themselves where institutional capital is flowing. Another concept repeated throughout the section is simplicity. None of the masters rely on dozens of indicators or complicated formulas to choose stocks. Their processes revolve around three things: price strength, clean patterns, and superior fundamentals where applicable. Simplicity keeps them consistent and reduces indecision. The chapter concludes with a unified message. Stock selection is not about prediction. It's about identifying the strongest opportunities and avoiding mediocrity. Great stock selection narrows the playing field so traders can focus on timing, risk, and execution. Without strong candidates, even perfect timing won't produce results. Momentum trading starts with choosing the right stocks, and this section shows exactly what the masters look for. Section 3 addresses one of the most decisive factors in trading performance: how much to buy. The masters make it clear that even with perfect stock selection and perfect timing, poor position sizing can destroy results. This chapter breaks down how elite traders think about capital allocation, risk exposure, and trade sizing in practical, rule-based terms. The section begins with a shared principle: position sizing is risk control. Minervini stresses that traders often obsess over entries, but ignore how much money they are putting at risk. He explains that a trader's worst-case scenario should always be measurable. If a trade goes wrong, the loss should be intentionally contained, not left to chance. Proper position sizing ensures that no single mistake threatens the account. Ryan expands on this idea by explaining the importance of keeping exposure proportional to conviction and market conditions. In strong uptrends, he may size positions more aggressively. In uncertain environments, he scales down. For Ryan, position sizing is dynamic. The market's tone influences how much pressure he is willing to put on any trade. He warns against equal weighting positions blindly, because not all setups carry the same quality or the same risk. Zanger takes a more momentum-oriented approach. His position sizes fluctuate based on volatility and how explosive a setup appears. If a stock is forming a powerful breakout pattern with high volume confirmation, he may size up to capitalize on fast moves. However, during choppy markets or in names with higher volatility, he reduces position size to avoid oversized swings. Zanger's method demonstrates a simple idea: volatility dictates size. Fast-moving stocks require tighter control. Ritchie II brings the most risk-sensitive view. He emphasizes survivability, the idea that position sizing exists to protect the trader from emotional and financial breakdowns. He discusses stress tolerance, meaning that your position size should never be so large that it distorts your decision-making. If a position makes you nervous or tempts you to break rules, it is sized too big. His message, proper sizing, is not just mathematical, it's psychological. One of the chapter's key themes is the use of risk per trade. While their specific numbers differ, all four traders operate from the concept of risking only a small percentage of total capital. On any single position, this creates a natural ceiling on damage. Multiple small losses are acceptable, even expected, as long as the trader avoids catastrophic drawdowns. Another major concept is scaling. Minervini and Ryan often start with partial positions and add as the stock confirms strength. This approach reduces initial risk while giving traders a chance to increase exposure when the trade begins working. Zanger, in contrast, may enter more aggressively but keep stops tight to compensate. Ritchie II tends to scale conservatively, preferring clarity before increasing size. The section also highlights the danger of oversized trades. The masters agree that most blown accounts come from either doubling down, averaging down, or placing too much size on trades that feel right. In momentum trading, confidence can be deceptive. Only price action should determine exposure. The chapter ends with a unifying conclusion. Position sizing is a discipline, not a guess. It's the mechanism that ensures long-term survival and allows traders to stay in the game long enough to capture big winners. You don't need huge size to win. You need consistent, controlled size that aligns with risk, volatility, and your own psychology. Section 4 focuses on how elite momentum traders use technical analysis not as prediction, but as a decision-making framework. The chapter clarifies a crucial idea early on. Technical analysis is valuable only when it helps traders identify behavior, probability, and risk, not when it's used to forecast the market like a crystal ball. The first major theme is price and volume as the core signals. All four traders agree that indicators, oscillators, and complex systems are secondary. Minervini explains that price and volume reveal the actual behavior of institutions, which dominate market movement. A stock cannot trend higher without sustained demand, and demand always shows up in the relationship between price movement and volume spikes. Technical analysis, at its core, is about interpreting supply and demand. Ryan reinforces this by emphasizing the structure of breakout patterns. He looks for stocks forming controlled consolidations, tight price action, and volume dry-ups before a move. These signs indicate that selling pressure is diminishing, and institutions are positioning for a breakout. According to Ryan, most failed breakouts share the same signature: sloppy patterns, wide volatility, and inconsistent volume. The pattern's cleanliness often predicts its quality. Zanger, known for pattern mastery, takes this further. For him, technical analysis is almost entirely about chart patterns and price behavior. He pays attention to flags, pennants, ascending bases, and high-tight flag structures because they reveal institutional accumulation in real time. Zanger warns that traders often obsess over pattern names but ignore the underlying behavior. A pattern is only valid if it reflects tightening supply and increasing demand. The message is clear: charts don't work because they're named. They work because they reveal psychology. Ritchie II brings in the role of risk definition. Technical analysis must provide logical levels for stops. If a chart setup doesn't offer a clear exit point, he views it as structurally weak. His framework is straightforward. A good chart gives you a low-risk entry and a well-defined failure point. If the market proves you wrong, you exit quickly and cheaply. For Ritchie, technical analysis is primarily a tool for containing damage. Another important concept in this chapter is trend alignment. Minervini emphasizes that traders should avoid fighting the trend. He focuses heavily on uptrending stocks above rising moving averages, particularly the 50-day and 200-day lines. Minervini warns that countertrend trades, buying pullbacks and downtrends, or guessing reversals, are the fastest way to erode capital. Momentum trading works because it rides sustained institutional demand, not because it tries to outsmart the chart. The masters also highlight tightness and contraction as leading indicators before major breakouts. Price ranges often shrink, volatility contracts, and volume dries up. This quiet period reflects diminishing supply. When volume resurges and price breaks the upper boundary, it signals demand overwhelming supply. A classic momentum trigger, a recurring warning throughout the section, is overcomplication. New traders often load charts with indicators instead of studying raw price action. The masters emphasize simplicity, clean charts, strong trends, constructive bases, expanding volume on advances, and tight action on pullbacks. Everything else is noise. The chapter concludes with unified guidance. Technical analysis is most powerful. When used to identify leadership, time entries, define risk, and measure strength, it is not about predicting the future. It's about reading real-time information and making disciplined decisions. Section 5 focuses on a core question many traders struggle with. How important are fundamentals in momentum trading? While momentum is usually associated with fast charts and technical setups, the masters explain that fundamentals still matter, but their importance varies by trader and by strategy. This chapter clarifies how each of the four traders integrates fundamental analysis into their decision-making. The first major distinction comes from David Ryan, whose foundation is the CAN-SLIM system. He places the strongest emphasis on fundamentals among the group. Ryan explains that exceptional price moves almost always come from companies delivering exceptional financial performance. He looks for accelerating earnings, strong revenue growth, rising margins, high return on equity, and leadership within an industry group. To him, fundamentals are not optional. They're the backbone of long-term winners. When a company's earnings and sales are surging, institutional buyers accumulate shares aggressively, which is the fuel behind major momentum runs. Mark Minervini shares many of Ryan's views, but uses fundamentals more selectively. Minervini focuses on a set of must-have metrics: strong earnings growth, expanding sales, improving margins, and signs of operational excellence. However, he doesn't require deep fundamental analysis beyond what is necessary to confirm leadership. For Minervini, fundamentals play a supporting role. They validate strength and help filter candidates, but technicals determine timing. His message: fundamentals show potential, technicals show reality. In contrast, Zanger relies far less on fundamentals. He pays attention to them, but only at a high level. Zanger primarily wants to know whether a company is growing and whether the story makes sense. Beyond that, price action leads everything. His perspective reflects the nature of his trading: fast, pattern-driven, and often focused on large-cap movers that don't always exhibit the explosive earnings found in early-stage growth stocks. Zanger's principle is simple: the chart will reflect fundamental strength long before financial reports do. Mark Ritchie II takes a balanced, almost minimalist approach. He cares about fundamentals mainly to avoid low-quality companies and to understand broad directional trends, but he does not dive deep into financial statements or rely on earnings projections. Ritchie's priority is risk. He uses fundamentals as a filter to avoid fragile businesses, not as a determinant for major exposure. If the chart is strong and the risk structure is clean, fundamentals play a secondary role. One of the central ideas in this chapter is correction versus confirmation. Fundamentals do not replace technicals, they complement them. A stock with great fundamentals but weak price action is not a buy for momentum traders. Conversely, a stock with strong technicals and improving fundamentals is a prime candidate. Another consistent theme is institutional behavior. Fundamentals matter because institutions, the whales that move markets, care about earnings power, revenue expansion, and competitive dominance. When fundamentals and technicals align, institutions typically increase their exposure, creating the momentum that traders seek to capture. The section also addresses a common mistake: traders either overvalue or undervalue fundamentals. The masters agree that fundamentals should be simple, clear, and directly tied to business performance. Overanalyzing financial data slows you down. Ignoring fundamentals altogether increases risk. The chapter concludes with a practical message: fundamentals help identify leadership and durability, but momentum traders win by executing through price action. Fundamentals tell you what to consider. Technicals tell you when to act. The strongest trades usually come from stocks where both are pointing in the same direction. Section 6 focuses on one of the most important realities of momentum trading. Your results are determined far more by the overall market environment than by individual stock picks. This chapter explains how the masters interpret market direction, why timing the general market matters, and how traders should respond to different market conditions. The chapter begins with a shared principle. Most major portfolio damage happens when traders fight the market trend. Minervini explains that even the strongest stocks rarely advance in a weak market. When the market enters a correction, volatility rises, breakouts fail more frequently, and leadership narrows. For him, staying in sync with the market's mood is essential. His method places heavy weight on price behavior in the major indexes, the number of stocks breaking out, and the health of leading sectors. When these elements weaken, he reduces exposure aggressively. Ryan reinforces this with his slim background. Historically, major market indexes and leading stocks confirm direction simultaneously. He focuses on distribution days, high-volume market declines, as warning signals. When distribution clusters, institutional selling is taking place, and traders must step back. Ryan emphasizes that ignoring distribution is one of the most expensive mistakes a trader can make. The market rarely reverses sharply without first broadcasting signs of trouble. Through repeated selling pressure, Zanger contributes a more pattern-based view of the overall market. He analyzes the Nasdaq and S&P 500 as if they were individual stocks, looking for tops, bases, breakouts, and failed patterns. For him, the indexes tell clear stories. Tightening ranges suggest compression. Wide swings signal instability. And failed breakouts in the indexes often precede sharp downside moves. His approach is visual. When the market loses structure, traders should shift into defense. Ritchie II frames the general market from a risk and liquidity perspective. He argues that traders must recognize when the environment supports momentum and when it punishes it. Market cycles are largely psychological. Greed expands liquidity, fear contracts it. When volatility rises and liquidity dries up, momentum strategies become less reliable. His emphasis is on adaptability. Instead of predicting market direction, traders should adjust position sizing, exposure, and aggression based on current conditions. A recurring theme throughout the chapter is that momentum strategies work best in favorable markets. Breakouts succeed when institutions are buying aggressively. Trend following works when indexes are trending. Tight bases resolve upward when demand is expanding. The masters stress that traders who try to force trades during unfavorable periods experience the majority of their losses. The chapter also addresses confirmation signals. These include leading stocks hitting new highs, rising number of stocks forming constructive patterns, expanding sector leadership, indexes staying above key moving averages, reduced distribution and increased accumulation. When these elements align, the environment is supportive. When they deteriorate, caution is required. Another major concept is staying out of the market is also a position. The masters repeatedly emphasize that cash is a strategic choice during corrections. Instead of trying to catch bottoms, they wait for strength to return. The chapter ends with a unified conclusion. Traders don't control the market, but they control their exposure. Mastering the general market, reading its signals, adapting to its phases, and respecting its power is what separates disciplined performers from traders who rely on luck. Section 7 breaks down one of the most misunderstood aspects of trading: when to enter a trade. The masters make it clear that successful entries are not about prediction or gut feeling. They come from a repeatable process built around price structure, risk clarity, and confirmation. The chapter begins with a shared principle. The best entries occur when multiple conditions line up: technical, psychological, and market-based. The traders don't buy randomly into strength. They wait for controlled setups where risk is quantifiable and upside potential is expanding. Mark Minervini emphasizes specificity above everything else. For him, an entry must have three key components: a strong stock forming a constructive base, clear evidence of accumulation volume patterns, tight price action, a low-risk pivot or trigger point where the stock confirms strength. He avoids early anticipation. Minervini stresses that entries must be executed only when the stock proves itself, by breaking through resistance with strong volume. His philosophy is simple. If the stock isn't showing leadership at the moment of entry, it's not ready. David Ryan brings a similar but more earnings-driven approach. His entries are tied to stocks that combine strong fundamentals with technical readiness. Ryan looks for bases that show multiple weeks of quiet trading, volume drying up, volatility contracting, because these signs suggest sellers have stepped aside. He prefers buying as the stock pushes through the pivot on heavy volume, confirming institutional demand. Ryan warns traders against buying during sloppy consolidation or low-quality setups, as these fail more frequently. Dan Zanger focuses heavily on pattern timing. His entries revolve around the specific geometry of chart patterns, flags, pennants, cups, and high-tight flags. Zanger wants to see tight, clean structures followed by explosive price action. He often enters slightly earlier than the others, but compensates with extremely tight stops. His message is clear: fast patterns require fast execution. If volume and price expansion show up simultaneously, hesitation kills opportunity. Mark Ritchie II approaches entries from a risk-first framework. For him, the right entry is defined by where the trade is invalid. A good entry gives a logical stop-loss level close to the entry point, which keeps losses small. Ritchie avoids setups where the failure point is unclear or too far below the entry. He stresses that if you can't define your risk, you don't have a true entry. You only have a hope. The chapter reinforces several common technical elements the masters rely on. Tight price action before the breakout. Volume confirmation on the entry day. Relative strength versus the market. Trend alignment stock above rising moving averages. Market support indexes confirming strength. A key point is avoidance of false breakouts. The traders explain that early or sloppy entries often lead to quick reversals. They use volume tightness and the behavior of leading stocks to filter out weak pivots. Another recurring lesson: great entries feel uncomfortable. Strong stocks rarely look cheap. The masters emphasize that buying strength, not weakness, is central to momentum trading. Many traders hesitate because they're anchored to past prices, but momentum entries require a forward-looking mindset. The section ends with a unified message. A good entry is not just a price level. It's a convergence of strength, structure, and controlled risk. When all these elements align, the probability of success increases dramatically. Section 8 is one of the most important sections in the entire book, because it centers on risk management, the discipline that separates long-term winners from everyone else. The masters stress that momentum trading is not primarily about making money. It's about protecting capital so you can stay in the game long enough to make meaningful gains. Every trader eventually learns that winning is a byproduct of survival. The chapter begins with a universal message from all for traders. The size of your losses determines the trajectory of your career. Big drawdowns destroy confidence, reduce capital, and make recovery mathematically difficult. Because of this, elite traders design their processes to avoid large losses at all costs. Mark Minervini emphasizes that risk control starts before the trade, not after. Every position should have a predefined exit point based on price structure. He stresses that traders must size positions so that if the stop is triggered, the loss remains within a predetermined percentage of account equity. Minervini's philosophy is systematic. Calculate risk, enter the trade. Execute the exit without negotiation. Emotional decisions are eliminated through preparation. David Ryan reinforces the importance of discipline by highlighting the danger of ignoring sell rules. Many traders allow small losses to grow because they hope the stock will recover. Ryan explains that this mindset destroys portfolios. He uses the historical patterns of market leaders to illustrate that the strongest stocks in any cycle can still collapse when the market shifts. When price breaks key levels or selling pressure intensifies, traders must exit without hesitation. Ryan frames risk management as a non-negotiable habit, not a tactic to use occasionally. Dan Zanger brings a more volatility-aware perspective. Because he often trades high-momentum stocks with sharp movements, he keeps stops especially tight. Zanger knows that fast movers can turn into fast losers. He stresses watching price action closely, when a breakout fails quickly, when volume spikes on down days, or when the stock loses pattern structure, he exits immediately. For him, charts reveal early warning signs long before fundamental deterioration becomes visible. Mark Ritchie II adds a psychological dimension. He argues that the purpose of risk management is not just to limit dollar losses. It is to protect mental bandwidth. Large losses damage a trader's emotional stability and distort future decision-making. Ritchie notes that traders often break rules after a big hit, trying to make it back, which compounds the damage. By keeping losses small, traders preserve clarity, confidence, and the ability to follow their system objectively. A recurring theme in the chapter is the asymmetry of losses versus gains. A 10% loss requires an 11% gain to recover. A 50% loss requires a 100% gain. Because losses compound against you, the masters treat risk reduction as the highest priority. The section also highlights several practical rules all for traders use. Never let a small loss turn into a big loss. Always know your exit level before entering. Follow stops mechanically, not emotionally. Reduce exposure when the general market shows weakness. Avoid adding to losing positions ever. Keep your worst-case scenario small enough to recover quickly. The chapter closes with a unified conclusion. Risk management is the foundation of long-term performance. You cannot control market outcomes, but you can control your downside. The traders stress that mastering risk is what allows momentum strategies to work. Without it, even the best setups fail over time. Section 9 shifts the focus from entering a trade to managing it once it's live, a phase where many traders lose discipline. The masters emphasize that even the best entry signals mean little if the trader cannot manage the position with structure and consistency. This chapter explains how elite performers handle trades as they develop, how they respond to strength and weakness, and how they avoid emotional decision-making during the life of a trade. The section opens with a universal principle. Trade management is about maximizing favorable conditions and minimizing damage. When conditions deteriorate, a trader's decisions after entering a position often determine more of the final outcome than the entry itself. Mark Minervini explains that trade management starts with respecting the stop loss. Once a trade is placed, there must be no negotiation with the stop level. It's a rule, not a suggestion. After establishing the downside boundary, he watches for confirmation signs, rising volume on up days, tight action near the pivot, and constructive follow-through. If the stock shows early weakness or fails to behave correctly within the first few days, Minervini is quick to reduce or exit. He treats early price behavior as critical feedback. Strong stocks should act strong immediately. David Ryan expands on this idea with a focus on post-breakout behavior. He studies how past market leaders behaved during their early advances. The strongest stocks often push 10 to 20% above the pivot before offering their first real pullback. Weak stocks often stall quickly or drift sideways with no conviction. Ryan uses this historical context to evaluate whether a stock is acting like a true leader. He gradually raises stops as the stock progresses, protecting gains without cutting the position too early. His management style balances protection with the patience required for big winners to develop. Dan Zanger approaches trade management with the mindset of a pattern trader. He monitors the integrity of the pattern after the breakout, channels, trend lines, volume characteristics, and the speed of the advance. If the stock breaks a key trend line or begins exhibiting abnormal volatility, he reduces exposure quickly. Zanger believes that charts reveal weakening demand before the price collapses. His management style is aggressive. He captures gains while the stock is moving fast and doesn't hesitate to cut when momentum fades. Mark Ritchie II adds a psychological layer. He focuses on avoiding emotional interference once a trade is active. His central rule: never let a winning trade become a losing trade. He uses trailing stops, partial sells, and incremental adjustments to stay rational and prevent large reversals. Ritchie avoids micromanaging trades, but insists on maintaining a defined structure, so decisions are rule-based, not reactive. Another major theme in this chapter is position adjustment. The masters discuss adding to winners only when the stock proves its strength. not based on hope or early speculation. Ads must be done at logical points, typically during secondary buyable moments, after constructive consolidations or pullbacks. The section also emphasizes recognizing the end of a move. Leaders often send clear signals, heavy volume reversals, failed breakouts, violation of key moving averages, or breakdowns in sector leadership. The masters exit when the evidence changes, not when emotions shift. The chapter closes with a unified philosophy. Good trade management is systematic, defensive, and responsive to price behavior. The goal is to stay aligned with strength, exit when conditions weaken, and allow winners to grow without exposing the account to avoidable risk. Section 10 focuses on what all for traders consider the decisive factor in long-term success: trading psychology. The chapter makes it clear that technical skill, stock selection, and timing all matter, but without psychological stability, none of those tools can be executed consistently. Momentum trading requires discipline not just during entries and exits, but throughout every phase of the market cycle. The section begins with a shared truth. Most trading problems are not market problems. They are self-management problems. Fear, greed, hesitation, ego, and the inability to follow rules create more losses than bad setups or market volatility. Mark Minervini emphasizes the importance of emotional neutrality. He argues that traders must remove hope, fear, and anticipation from the decision-making process. His view is simple: if a trader follows rules mechanically, emotions become irrelevant. He stresses developing a mindset of detached execution, where each trade is treated as just one iteration in a long series. Minervini believes confidence comes from discipline, not intuition. When you know your plan and have proven it works, there's no need for emotional input. David Ryan discusses the value of learning from mistakes without internalizing them. He explains that traders often overreact emotionally to losses, interpreting them as personal failures. This creates hesitation and self-doubt, which then leads to worse decisions. Ryan suggests treating each mistake like a data point. Review it, understand it, adjust the process, and move on. The most damaging psychological habit is refusing to learn because ego gets in the way. Long-term performers confront mistakes directly and use them to strengthen their systems. Dan Zanger provides a caution about euphoria, the psychological trap that often appears after a winning streak. He warns that traders become vulnerable when they believe their recent success represents permanent skill. Overconfidence leads to oversized positions, ignored stop losses, and risk-taking beyond a trader's tolerance level. For Zanger, humility is a protective tool. Even during strong performance periods, he reminds himself that markets change quickly, and staying grounded keeps him from giving back gains. Mark Ritchie II brings a behavioral perspective. He stresses self-awareness as the foundation of psychological mastery. Traders must know their personal tendencies: fear of missing out, impatience, revenge trading, or attachment to losing positions. Ritchie explains that no system can compensate for psychological blind spots if they remain unaddressed. He encourages traders to track emotional patterns just as carefully as they track price patterns. His core message: psychology is not something to overcome, but something to monitor and manage continuously. A repeated theme in this chapter is the importance of process over outcome. The masters agree that traders who obsess over making money tend to break rules, while traders who focus on executing their method correctly achieve better results over time. Money is a lagging indicator. Discipline is the leading indicator. Another major concept is resilience. Drawdowns, bad trades, missed opportunities, and market corrections are inevitable. The difference between professionals and amateurs lies in response. Pros reduce size, reset mentally, and return to the process. Amateurs spiral into emotional decision-making. The chapter concludes with a unified message: trading psychology isn't optional. It's the infrastructure that supports every strategy and every decision. Master the emotional game, and the technical game becomes far easier. Section 11 serves as the conclusion of Momentum Masters, but instead of offering motivational slogans or storytelling, it consolidates the core principles shared by the for traders throughout the book. The section reinforces the themes that consistently appeared in every chapter: discipline, process, risk control, market awareness, and personal responsibility. It's a summary of what truly matters for long-term success in momentum trading. The chapter begins by emphasizing the power of consistency. The traders point out that success is not achieved by finding perfect trades or predicting major market moves. Instead, it comes from applying a repeatable methodology day after day. They highlight that a winning system is worthless unless it is executed consistently. Variability in behavior leads to variability in results, and variability is the enemy of compounding. Next, the section underscores the simplicity of effective trading principles. None of the masters rely on complex indicators, sophisticated algorithms, or exotic theories. Their edge comes from focusing on essential factors: strong stocks, strong patterns, strong fundamentals where applicable, and strong market conditions. The book's overarching lesson is that traders who simplify tend to outperform traders who complicate. Another major theme is the centrality of risk management. The masters repeat that controlling the downside is the true foundation of trading longevity. They stress that your worst trades reveal more about your success potential than your best trades do. Big losses indicate a breakdown in discipline, not bad luck. Small, contained losses show that the trader is respecting process, controlling ego, and protecting future opportunity. Risk management is not a defensive strategy. It is an offensive advantage. The chapter also revisits the importance of market alignment. Even the best stocks and best setups fail when the market environment is hostile. The traders highlight that understanding the market's character, whether it's trending, correcting, or transitioning, is essential. The market provides context, and context determines probability. Momentum trading is effective only when the wind is at your back. Another key message is self-awareness. The traders emphasize that sustained success requires understanding personal tendencies, emotional triggers, and psychological weaknesses. They encourage traders to build a system that fits their temperament instead of forcing themselves into patterns that create stress or confusion. Self-awareness is framed as a long-term competitive advantage because emotional stability fuels consistent execution. The section also addresses the role of continuous learning. The market evolves, leadership changes, volatility shifts, and trader psychology fluctuates with experience. The masters recommend ongoing study of past winners, past mistakes, and current market conditions. The goal is not to reinvent the system, but to refine understanding and maintain sharpness. As the chapter closes, the book delivers its final unified principles. Protect capital at all costs. Follow rules with discipline. Trade with the trend, not against it. Stay patient during weak markets. Act decisively when conditions improve. Focus on process, not prediction. Allow big winners to work while keeping losses small. The final message is straightforward. Momentum trading works when executed with discipline, structure, and emotional control. The system is simple, but the challenge is mastering yourself. For traders willing to commit to process over emotion, the potential for consistent success is real. Momentum Masters delivers one of the clearest, most practical breakdowns of high-performance momentum trading available today. Instead of presenting a single viewpoint, the book distills the combined experience of for elite traders Mark Minervini, David Ryan, Dan Zanger, and Mark Ritchie II, and allows readers to compare how top performers think, execute, and manage risk in real time. The result is a structured framework that removes the noise and focuses on what consistently works across market cycles. The core message running through the entire book is simple. Success in trading is built on discipline, not prediction. Each of the traders has a different style and personality, yet they converge on the same essential principles. They choose strong stocks, wait for clean setups, manage risk aggressively, and stay aligned with the overall market. Their methods differ, but their foundation is identical. Protect capital, follow rules, and let price action confirm your decisions. The book emphasizes that momentum trading is not a game of catching bottoms or predicting tops. It's a process of identifying leaders, companies showing superior earnings, strong sales growth, strong price behavior, and clear institutional accumulation. You aren't trying to outsmart the market. You're trying to participate in strength while avoiding weakness. That requires patience during corrections and decisiveness when conditions improve. One of the strongest takeaways is the absolute importance of risk management. The masters treat risk like a first language. Every trade begins with a predefined exit. Position sizing is calculated based on downside, not upside. Stops are hit without debate, and no trader in the book adds to losing positions ever. This risk-first philosophy is what gives momentum traders longevity. Big wins matter, but avoiding big losses matters more. Another major theme is self-awareness. The traders stress that psychological mastery is the cornerstone of consistent performance. You must understand how you react to fear, greed, volatility, and uncertainty. You must build a system that fits your temperament. And above all, you must follow your rules when emotions try to pull you away from them. According to the masters, self-control is the real competitive edge, not secret indicators or market predictions. The book ends with a clear framework for success. Trade in sync with the market. Focus on leadership stocks. Execute entries only when price action confirms strength. Keep losses small and immediate. Manage winners with structure, not emotion. Stay patient, systematic, and self-aware. If you apply these principles consistently, momentum trading becomes less about luck and more about discipline-driven performance. If this breakdown helped you understand how elite traders actually think, make sure to hit that like button so more people can discover this content. And if you want deeper dives into financial books, trading psychology, and real-world strategies, subscribe to the channel. We drop new videos every week. Have questions about momentum trading? Want a full script on another book? Drop a comment below and I'll cover it in a future video. Thanks for watching. Now let's keep building your financial IQ.